scramble for dollars. There is a serious dollar shortage. So in a credit crunch, or in going into recession, the dollar, of course, it was, on a tear in 2021, most of 2022. It got to levels maybe technically not higher than 2000. I was on vacation with the family and friends, and we were in the French Alps in 2000, and the euro was 80 cents. And we go out with the two families. We couldn't spend $100 if we tried. I mean, we ordered wine, 4-course dinner. You couldn't spend $100. It was wonderful. But then, the euro bounced back, got up to $1.60 in the kind of early 2000s. But so the dollar was that strong, and you really have to go back to 1985 to find a dollar that strong. And what happened in 1985? James Baker convened the Plaza Accord. It was basically, it wasn't the G7 strictly, but 5 major economies, Japan, Germany, a few others, to weaken the dollar intentionally. The dollar was just way too strong, and they did. And then the Louvre Accord in 1987 was like, okay, we did it, now let's stabilize. But that whole period of the 80s, mid 80s, 85 in particular, that's the last time the dollar was this strong. Now, dollars come off a little bit, kind of starting in October. You look at the Bloomberg Index, the Wall Street Journal has DXY, the Fed has their own index. This is one I use, broad trade weighted. But I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking about. If we're talking about the kind of recession that I've described, and if we're looking at the kind of yield curves, and then another question is, well, apart from the fact that it's reliable warning a recession, which it is, what's behind the curtain? What are the real reasons why the yield curve is sending a very bad signal? We interpreted the signal, but why? Why is it happening? The answer is there's a mad scramble for dollars. There is a serious dollar shortage, and people roll their eyes. They're like, wait a second, the China's dumping treasuries, country Brazil's dumping treasuries, people hate the dollar. China's talking to Saudi Arabia about paying for oil and yuan. What do you mean there's a dollar shortage? Well, there is, because, and we can see it, but there's a reason for it. I'm acquainting people with what I call the Q word, which is quadrillion. 1 quadrillion is 1,000 trillion. That's approximately the notional value of all the derivatives, off-balance sheet derivatives of all the banks and hedge funds in the world. It's about 1 quadrillion. We're talking options, futures, swaps, swaptions, FX forwards, the whole thing, but they're all off-balance sheet. So they don't show up in conventional ratios. You got to read the footnotes, and they don't tell you that much. So okay, that's an awful lot of. What supports that? How do you get a $1 quadrillion position, 1,000 trillion? Well, the answer is collateral, but not that much. It's a little sliver. It's kind of like 1% collateral under the 1 quadrillion. Okay, so in a credit crunch, or in going into recession, which is where we are. What do banks say to each other, and what do banks say to the hedge fund clients, et cetera, in terms of the quality of collateral? They say, I don't want your mortgages. I don't want your corporates. I don't even want 10-year treasury notes. I don't want 5-year treasury notes. I want treasury bills. That is the best, least volatile, most liquid, most creditworthy instrument in the world. And in a world where balance sheets are contracting, credit fears are rising, the economy's turning down, everyone's worried about this, and I was general counsel and chief credit officer, one of the biggest government securities dealers for 10 years. And I know, you walk around the floor, and the guys on the repo desk, whatever, they're bargaining with their counterparties every morning. They're insisting on treasury bills. Well, if you're Deutsche Bank or Barclays or HSBC or Unicredit or Banco Santander, you have a central bank that doesn't print dollars. ECB can print all the euros you want, but doesn't print dollars. So where are you going to get the dollars? Well, if you want to buy dollar-denominated treasury bills, you got to get dollars so you can pay for them. Well, that's what's driving this. That's what will drive the dollar higher. And then now you can do currency swaps. There are kind of other ways to get dollars, but they all involve risk. They all involve more off-balance sheet. You just kind of deferring the problem a little bit, because at some point you got to unwind the swap. and you basically short dollars because you had to get them. And if the dollar gets stronger, you just lost more money, but you put it off for a few months. Now, people look at the TIC reports. That's the Treasury report of what foreign central banks and sovereign wealth funds own the U.S. Treasury market. That's what it is. And you'll see that China's Treasury security balances are going down, India down, Switzerland down. And you're like, that means they hate the dollar. The answer is no. They love the dollar, but they're desperate. They have to get dollars to prop up their own banks. If you're the People's Bank of China, you got to prop up the Chinese banking system. If you're the Swiss National Bank, you got to prop up Credit Suisse, and et cetera. And so if you can't print dollars, which you can sell dollar securities, get the dollars, and then lend them to your own banks, who can then go out and buy the Treasury bills. Another inversion it's not too esoteric. The Fed will actually give you all the Treasury bills you want. All you have to do is just do a reverse repo with the Fed. You deposit your cash with the Fed, and they send you Treasury bills, and it's like, can be overnight, 1 week, whatever, and at some point you unwind it. But what you usually do is just roll it over. So a phone call to the Fed will get you all the Treasury bills you want. So why doesn't that solve the problem? Because if you look at auctions, Treasury auction, by the way, everything we're talking about is now messed up by this debt ceiling debate, because the Treasury can't sell new bills. They can't. They can roll over, but they can't increase the bill issuance because they're at the debt ceiling.
Until the ceiling is lifted, yeah.
Correct. But until the ceiling was hit, so when, but they can issue new to roll over. When banks and primary dealers bid at Treasury auctions for Treasury bills, they get a certain rate. The more I pay, the lower the yield. But I can call the Fed and they'll send me some Treasury bills. The rate at which the Fed will give you bills on a reverse repo basis is higher than the rate that the dealers get when they bid at auction. So why would you do that? Why would you bid at auction to get a yield that's lower than what the Fed will give you for a phone call? Mm-hmm. The answer is the Fed bills cannot be rehypothecated. They can't be used the way the dealers want. They can't send them to Deutsche Bank. But if I buy the bills at auction, I can. And so there's a liquidity preference for buying Treasury bills at auction, because I can pledge them to somebody else, and that's what they do. But if I do the reverse repo, I got to hang on to them because the Fed won't let me rehypothecate. And so that's why the yield to maturity at auction is lower than what the Fed will give you basically for free. But it's another one of these weird, quirky little inversions, but it tells you something. It tells you exactly what I said, which is there's a dollar shortage. And that will get worse as we go into a recession and credit losses pile up and banks get stressed and balance sheets get reduced and dealers say, it's Treasury bills, and I don't even want 1 year bills. Give me a 3-week, give me a 4-week bill. That's going to drive the dollar higher against basically the euro.